Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 ways to invest with little money. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10. Try the cookie jar approach. Saving and investing money are inextricably linked. You must first save money before you can invest it. That will take much less time than you think, and it can be done in very tiny steps. If you've never saved before, you can start with just $10 every week. That may not seem like much, but over the course of a year, it adds up to more than $500. Put $10 in an envelope, shoebox, small safe, or even the cookie jar, the famed bank of last resort. Though it may appear ridiculous, it is frequently a crucial first step. Make it a practice to live on a little less than you earn and save the difference in a safe location. Opening a high-interest savings account is the digital version of the cookie jar. They are distinct from your checking account. If you need the money, you can withdraw it in 2 business days, but it is not tied to your debit card. When the hoard is substantial enough, you can withdraw it and put it in legitimate investment instruments. Number 9. Enroll in your 401k or similar retirement plan at work. If you're on a limited budget, even enrolling in your 401k or other employment retirement plan may appear out of reach. However, you can start investing in an employer-sponsored retirement plan with little amounts that you won't even notice. Plan to put 1% of your salary into the employer plan, for example. You probably won't even notice a contribution that small, but what makes it even easier is that the tax deduction will reduce the amount even further. Once you commit to a 1% commitment, you can gradually increase it each year. In year 2, for example, you can increase your contribution to 2% of your earnings. You can increase your contribution to 3% of your pay in year 3, and so on. Number 8. Open an IRA. Employer-sponsored 401ks are excellent, but they do not provide the same tax benefits as other retirement accounts, which is why starting an IRA is also critical. For starters, because you're starting your own personal IRA rather than going through your company, which chooses your investments for you, you'll have more investing possibilities. Furthermore, one of the most significant advantages of an IRA, particularly a Roth IRA, is the opportunity to grow tax-free. Your account will grow tax-free, and you will be able to make tax-free withdrawals beginning at the age of 59-12. You may open an IRA on any of the best investment platforms, but if you're just getting started, we recommend Acorns. You can invest as much or as little as you wish in ordinary investing accounts or an IRA with Acorns by setting up recurring investments of as little as $5 each day, week, or month. Number 7. Let a robo-advisor invest for you. Robo-advisors first appeared on the financial market approximately a decade ago with the goal of making investing as simple and accessible as possible. You don't need any prior investing experience because robo-advisors eliminate all of the guesswork. Robo-advisors invest your money in a highly diversified, low-cost portfolio of index funds, mutual funds, and slash or bond funds after asking you a few simple questions about your goals and risk tolerance. Robo-advisors then utilize algorithms to constantly rebalance and tax optimize your portfolio. There is no easier method to begin a long-term investment. Most robo-advisors demand little money to get started and charge reasonable fees based on the size of your account. All provide automated investing options to assist you in increasing your balance. The expense of robo-advisors is the only disadvantage. Robo-advisors charge an annual fee that is calculated as a percentage of your balance. The industry standard is around 0.25%. If you invest $10,000, you will pay $25 per year. That's not a lot of money, but it adds up quickly when you accumulate hundreds of thousands of dollars. Number 6. Start investing in the stock market with little money. Stock market investing can take numerous forms. It may not always imply purchasing individual stocks. Buying index funds or mutual funds is another way to invest in the stock market. Index funds and mutual funds are baskets of equities in which your small investment can purchase a portion of the entire portfolio. Index funds track an index, such as the S&P 500, and include the same companies in the same proportions as the index. They are administered passively, sometimes even by a computer that merely follows the index. As a result, management fees are often fairly modest. Mutual funds are likewise sets of stocks that you can invest in, but they are actively managed and follow a set of objectives specified by the company rather than an index. For example, the fund may only invest in companies that are growing. Alternatively, if income is the goal, it will exclusively invest in dividend equities. You can, of course, invest in individual equities. There are a growing variety of solutions that are allowing a new generation of investors to get started with as little as $1 and no transaction commissions. Number 5. Dip your toe in the real estate market. To invest in real estate, you no longer need a lot of money or even good credit. A new investment category known as real estate crowdfunding allows you to purchase fractional shares of huge commercial buildings without the hassle of becoming a landlord. Crowdfunded real estate investments have higher minimum investment requirements than robo-advisors, for example, $5,000 rather than $500. They are also riskier investments because you will put your entire $5,000 into one property rather than a diversified portfolio of hundreds of separate investments. The benefit of owning a piece of a real physical asset that isn't always associated with the stock market is appealing. As with robo-advisors, investing in real estate through a crowdfunding site incurs fees that you would not incur if you purchased a building directly. However, the benefits are clear in this case. You share the expense and risk with other investors, and you are not responsible for the property's upkeep or even the paperwork to purchase it. Real estate crowdfunding, in my opinion, can be a fascinating method to learn about commercial real estate investing while also diversifying your holdings. I wouldn't put all of my money into these platforms, but they are an interesting alternative investment. Number 4. Buy a mutual fund. Mutual funds are financial vehicles that allow you to buy a portfolio of stocks and bonds in a single transaction, making them ideal for first-time investors. The problem is that many mutual fund providers need initial minimum investments ranging from $500 to $5,000. If you're a first-time investor with limited funds, those minimums can be prohibitively expensive. However, some mutual fund firms will waive account minimums if you agree to make recurring monthly investments of $50 to $100. If you can accomplish it through payroll savings, an automatic investment arrangement is especially convenient. You may usually set up an automatic contribution through your payroll, much like you do with an employer-sponsored retirement plan. Simply ask your Human Resources Department how to get started. Number 3. Money market mutual funds. Money market mutual funds invest in a wide range of fixed income assets with short maturities and low credit risks. They typically pay a low interest rate, but unlike other types of mutual funds, there is little opportunity for capital appreciation. This sort of investment provides a lot of liquidity, and because of the types of investments they make, they are thought to be quite safe, with little chance of losing money. However, unlike savings accounts or CDs, they are not FDIC insured. Money market mutual funds are best used as a safe haven for cash that you wish to keep close at hand in case of a large purchase or another investing opportunity. Number 2. Fixed annuities. Fixed annuities are a popular type of annuity contract that is commonly used for retirement planning, but they can also be beneficial for medium-term financial goals. Businesses that provide insurance and financial services can sell fixed annuities, which guarantee a rate of return for a specific period of time, regardless of market conditions. An annuity's life is divided into 2 stages, the accumulation phase and the payout phase. In the first, you make periodic payments into your annuity and earn interest, which increases the value of your account tax-deferred. The payout phase can take the form of a single lump sum payment or a series of regular installments over time. Although inflation can reduce the value of a fixed annuity, many firms offer cost of living adjustment, COLA, riders that help your annuity's value keep pace with growing expenses. Number 1. Invest for the long term. Investing little sums of money each month may appear trivial. However, over the course of 20 or 30 years, you could have created a substantial pot. If you plan to keep your money invested for decades, you can afford to take on greater risk than someone who needs access to their money in the next few years. Investing is best for the long term since the longer your investment horizon, the more time you have to ride out the tough periods until prices recover. Investing in a pension is a fantastic way to do this because they qualify for government tax breaks, as well as supplementary contributions from employers for those in workplace pension systems. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.